But that's the initial tick this morning, or the opening trade. 17,000 being held on to, but a far cry from the 17,100 mark. We're down 0.5% for the Sensex as well as the Nifty. For the Sensex, 358 points shaved off. The broader markets, in comparison, it's a fall that's far more measured, so just down about 0.33%. To the big losers then, and the metals index loses out the most. Media in the red, IT, PSU banks, not to mention the Nifty Bank on the back foot, down about 0.7%. Let's just quickly take it to some of the Nifty drags. Adani Enterprises, TCS, IndusInd Bank, Maruti, HDFC Life, Tata Steel, those are some of the drags in trade. To the newsmakers then, HDFC Bank, merit to mention the NCLT approving the merger between both the banks on Friday afternoon, and those stocks reacting. Meantime, Tata Consumer, remember we've got that news as well that the negotiations with Bisleri for that potential acquisition as of now have been called off. Canfin Homes, they've appointed the former Bandhan Bank Housing Finance head, Suresh Iyer, will be taking over as the CEO. You've got GMR Infra as well. They're going to raise close to 2,900 crores via the FCCB route. A quick check-in on that stock. Cochin Shipyard, it's a project that they've bagged worth about 550 odd crore rupees. Godavari has approved a share buyback via the tender offer route. Take a look at Sumitomo Chemicals as well, as the Pollution Control Board has revoked the closure order for their Bhavnagar production site. A quick check-in on Adani Enterprises as well, as we understand that their petchem projects, according to reports, have been suspended. Biocon as well, they've sold some shares as well at about 200 rupees per share that have been sold in the counter, while Bless GVS is on the spotlight as the US FDA has issued a Form 483 on their Palghar unit. Within the broader markets as well, just going to take a look at the movers. We've got a downtick of about 0.5% or so for the mid and small caps. The Adani group of stocks, something like Ujjivan, BASF, Infi, HAL. And on the flip side, you've got Cochin Shipyard gaining smartly. Blue Star, Responsive Industries, Rail Vikas Nigam continues its upward move, and you've got a Manappuram Finance in the green. Kunal, sub 17K on the index, and it's just been 2 minutes that we've started off trade. What's your view on levels, and take us through your first trade, of course?
So, yeah, I think it's an at par, start what we were expecting. The index down some 100 odd points on the Nifty. I would expect 17,020 to be a good level to initiate a contra buy on the Nifty futures for intraday traders. So I'll wait for maybe another 20-30 points on the downside to initiate a buy. Now, in terms of stocks, Tech Mahindra is a stock which I believe looks very attractive. The stock is heading towards a breakout about that 1150 mark. The stock has gone through a multiple test of those levels. So I believe an eventual breakout is something which I believe looks attractive from a trend setup for Tech Mahindra. That's a stock which I'll look to buy.
Okay, so Tech Mahindra is something that is definitely catching attention of Kunal. But just in terms of some of the other stocks that I wanted to flag out, Cochin Shipyard we have talked about because of the big order that they have backed, so a 5% move coming in there. And you also have Kalyan Jewelers, which is showing quite a bit of traction, 3% higher. Biocon, remember there was a fresh note coming in from Morgan Stanley, wherein they believe that the share price will rise in absolute terms over the next 15 days. So it's a bit of a positive catalyst watch coming in for Biocon from Morgan Stanley, and the stock usually reacts on account of that. So today as well, Biocon is up around 3% on account of that particular brokerage note. On the losing side, it's the Adani group of counters that continue to really under pressure. Gas, transmission, green, they're all down and out. Enterprise, as we flagged out, and also Jubilant Life staying with a cut of around 3.5%. But Nooresh, what about your first trades? Is there any stock that is, catching your attention at this point of time as a good trade?
So that would be L&T. The stock is shaping up for an eventual breakout about 2200, 2220 level. So today's dip is a good entry point at 2180. Expecting it to break out going forward. Been the best performing stock in the large cap as of now. Over the last few sessions has not corrected. So like L&T for the short term.
Okay, there you have it. Those are the first trades that our chartists are betting on. But let's get a move on then and connect with Sailesh Rajbhan. He is the CIO Equity Investments at Nippon India Mutual Fund. Thank you so much for taking time out. Now, to begin with, Mr. Bhan, given the fact that we've been bombarded with a slew of headlines from across the globe, you had the fall of the major banks and the rescue steps coming in. In light of that, the markets have definitely borne the brunt of it back home. While there may not be any correlation with the Indian banking system, as a whole, how are you looking at our markets shaping up in light of this kind of volatility and news headlines?
Yeah, hi, good morning. Like you said, global challenges have been now continuing for nearly about 18, 19 months, with the start of the war and, the high inflation and interest rates. I think these are all, what's happening today is more a function of how the underlying conditions shifted maybe 18 months back. And that is what is getting reflected, or the outcome of that is getting visible to you in the increased volatility today, market adjusting to a normal world versus how the market used to be earlier in terms of looking at extremely low interest rates as a base case forever. So I think we are in that adjustment phase, and this is certainly hitting global demand. This is certainly hitting the growth outlook for Indian companies. In fact, if you look at what's happened in the last, 2 to 3 quarters in India, earnings have been fairly muted. In fact, we have been trending late single-digit earnings kind of growth, against generally trying to do 13-15%, which India has the potential to deliver. So I think we are already facing the impact of it, and I think some cases it's a function of today we are in the midst of bad news, which is in a way now starting to give attractive prices for Indian equities. In fact, last 3 months have seen many, at least outside index companies, correcting and becoming more attractive. So I think it's a journey where we are in an environment of low earnings, at least for a couple of quarters, even from India, and where the valuations generally stand. I think we could just middle around for a period of time till we come back to stronger earning growth path.
This is Anish also joining into the conversation. So what are you doing with the deployment plans at this point of time? Are you keeping your powder dry, increasing your cash levels to probably look at better entry opportunities, or let's say accumulating opportunities for some of your funds, or are you nibbling into the markets in select stocks?
Yeah. Interestingly, while the indices have remained flattish for 18 months, so they have seen some kind of time correction, over the last 3 months, we are finding material price corrections also happening in many pockets of the market. So relative attractiveness is certainly emerging in some places where the fundamental news remains to be weak in terms of near-term earning growth. So I think those are giving us opportunities to shift our portfolio to businesses which are more sensibly valued. So our focus has now been buying growth companies which are available at sensible prices, and that's been our approach to manage risk as well. So end of the day, not overpaying for growth, choosing selective businesses which are now better priced in the market is where we are focused on deploying our capital. As a fund house, we generally don't take significant cash calls as per our own investment policy and framework, and our idea is to continuously keep scouting for good available investable businesses at reasonable prices from a 3-year horizon.
Fintech stocks, would you call them high growth businesses available at really ridiculous price points, or now they're also looking reasonable?
Yes, could you repeat the first part, the fintech businesses?
The consumer tech fintech stocks, I mean, these are high growth businesses. Since you said that you want to buy growth businesses at a reasonable price, where does the word value fit in for a Zomato or a Paytm, or for that matter, Nykaa?
Okay, so the question is more on the new age kind of businesses where you definitely don't have, really don't have any specific near-term cash flows and businesses which are strong. So the approach to this is very simple. Was if you are getting these businesses at a justifiable, reasonable valuation, even if you look 3-4 years out, giving a couple of years more for them to demonstrate the right profitability, that I think is, in some cases, might start getting interesting. Are they at throwaway valuations? No. I think very few businesses in the new age space are in throwaway valuations. And I think in the listed space, the valuations are much better than what they used to be a few months back, but I think they are not at throwaway valuations. The key point in these businesses is whether each of these businesses have a right to win. So if they have a right to win, we can pay a premium because we know there is longevity to do these businesses. And I think when you have that kind of a framework in play, I think these can be valued a little more higher than other businesses because they have a longevity of growth, and that is what is the premium we'll be willing to pay. But excessive froth and all that, which has evaporated or has gone away, I think it's still not in the value zone, as you might call it. But I think opportunities will emerge and are emerging continuously.
So what is cheap in this market? What is cheap and where growth could be more than the earnings average? Because ultimately you get a combination of cheap and a reasonable amount of growth, you will make decent compounding returns.
Yeah, so we look at sectors, where there is reasonable growth visibility. For example, banking. Right, banking is reasonably priced, right, with a strong or a good medium-term outlook, because I think the perils of the past or the challenges of the past are behind, and we are now getting into demand for credit and a reasonable environment for growth. It's not cheap, but it's actually maybe reasonably priced businesses with strong visibility. Similarly, pharmaceuticals. Now they are very reasonably priced. Secular nature of the businesses will start kicking in because all the ups and downs of COVID are behind, and hence at valuations which are 40-50% cheaper than consumer businesses, these appear very good opportunities to play in. Utilities, I think for the growth they are delivering or starting to deliver now, are meaningfully attractive. So that's one more space which is there. One space where valuations may not be attractive but growth outlook is very strong is the engineering and manufacturing, right? And their corrections of these kinds and this kind of global bad news can allow for increasing exposure to those spaces. So these are the four spaces we find reasonably attractive from a 3-5 year investment horizon, and that is where our focus today is in selecting businesses. Plus outside these four spaces, you're getting a lot of businesses seeing meaningful corrections in the last 3 months. So it's just possibly people giving up on the high growth rate expectations of those businesses. There are certain ignored sectors like insurance and all which have suffered some challenge because of what's happened in the budget and the high valuations of the last 3-4 years coming off a bit. I think directionally those businesses are getting attractive from a medium term kind of horizon. So I think it's a mixture of moderate growth outlook for businesses coming at reasonable prices. It's not still very cheap prices for most of the businesses.
So is the valuation now reasonable or attractive for the IT counters as well? Because growth is something which is definitely slowing. There is then the entire BFSI pressure plus the changes of leadership. How does the IT sector stack in your assessment of valuation versus growth?
There is still some time correction possible in these businesses because general growth rates have been coming off or likely to come off meaningfully because the main markets are just entering the challenging phase, which is US and European markets. So I think for this sector, even though valuations seem to have corrected, the earning uncertainty still remains. If these businesses are back to 8-10% earning growth, I think the current 20 multiples may not be sustainable for a lot of these businesses. So I think, as we have seen in the past, multiples do correct significantly when growth evaporates. And I think directionally, if you are looking at single-digit earning growth for these businesses, you may still have some time for these sectors to be becoming very attractive from an investment point of view.
The years you've really, in a sense, identified pharma. You've owned stocks like DVs, then MNC pharma names. What's gone wrong there? One company after another company either is getting hit because of US FDA or pricing power or both. And it's not only just US based companies. With the exception of few domestic companies, the entire sector per se now is going through a tough time. Shailesh, pharmaceuticals. I think we've lost him there. Bad audio. Just a bad audio. Doesn't matter. We'll try and get that connection, established with Shailesh Bhan. He's bought a lot of pharma stocks. I mean, I've tracked his funds for years now. He's bought into DVs. He's bought into MNC pharmas. They were those stable businesses which are growing at 15-20%. So let's see if we can get the connection back with him. Do we have him back? Okay, I think I'm just going to mark the markets and there you go. I mean, what do we have? On a day when Credit Suisse was bought over by UBS and the biggest concern in the European financial market has got addressed, there is just no strong price action in any of the major indices. All sectors, and I can literally tell you that with the exception of HPCL and BPCL, which is largely going up because of oil prices, everything is trading with a negative bias. Shailesh, you've bought pharma stocks in the past, names like DVs, MNC Pharma, but now turn by turn, every pharma company is having a challenge. Product challenge, pipeline challenge, US FDA challenge, pricing challenge. What's gone wrong for that sector?
I think interestingly, this has also gone through a cycle. What you have seen of a very sharp rebound post-COVID. I think that has come off a bit, and I think we are now back to very normal stocking of inventory, normal business environment for these companies. Now, you mentioned about 3 or 4 challenges. I think the biggest challenge has been the expensive valuations in select pockets of pharma space, where stocks went up 3-4 times in a very short period of time because of COVID-led products driving or expected to drive their substantial growth. I think those corrections have happened. If you look at a normalized business conditions, most of these companies on core earnings are still growing 10-12%. It's just that they had a bump up of profits coming from COVID, which have driven very significant re-rating for select businesses, and they have now normalized for growth. Second is area where the challenge, which is real, has been the US pricing environment. I think US market has suffered on a profitability point of view fairly significantly. And we have seen price erosions continue there despite already lower prices and due to high competitive intensity. I think that phase still continues and US market attractiveness remains fairly modest. But the core for pharma, which is the branded domestic space, remains as strong as ever. We are seeing meaningful increase in diagnosis, hopefully shifting to greater compliance, and also the opportunity here for getting new patients into treatment and giving them solutions, I think is very, very significant. The domestic branded space has still meaningful decades-long growth opportunity which exists, and that is where I think our focus should be and our focus is towards, because these are branded businesses. Virtually leaderships don't change here very easily in terms of the categories and the products people operate in, and the chronic market play of India continues to support growth in a lot of these branded Indian pharmaceutical businesses.
All right, we'll let you go on that note. Appreciate your time. Thank you so much for joining in and giving us a view on what the construct of the portfolio should be, as well as your outlook on the markets. We're sub the 17K mark. It's down 1% for the frontline indices, and lest I say it's across the board as well. So the broader markets too have succumbed to that selling pressure. Just identifying some losers: Adani Enterprises and Transmission, Bandhan Bank loses 2.5%, M&M in the red, Tata Steel, SBI, UPL, along with NMDC. We're moving right on then. We had Nikunj, who was in conversation with Ravi Dharmshi, the CIO at ValueQuest Investment Advisors. Let's listen into this very special interaction.
Well, what kept at least ET Now busy on Saturday was the grand ValueQuest event. And of all the events I've attended in the last 2 decades, this certainly was one of the grandest events I've attended, both in terms of participation and also in terms of really showcasing the India theme. So the architect of that event, Ravi, he joins us now. Let's take a conversation forward to understand what are the key takeaways of the ValueQuest annual event, what his view on the market is, and is he really bothered about Credit Suisse or UBS or none? Ravi, what a lovely event. It was really a wonderful, in a sense, wonderful forum to really showcase that where India is headed.
Yeah, no, I think I strongly do believe that India is at an inflection point. We were calling our conference a VQ Inflection Day, but that is about inflection is in India. Inflection was for us also personally. Of course, we have grown a lot in the last 2-3 years. But from India's point of view, see, India is going from being a $3 trillion economy to 5 and 10 eventually over the next 6, 7, 8 years. And when that is going to happen, it is going to kick in a big consumption J curve. The discretionary spends are going to go through the roof. Surely we are facing some shorter term headwinds. So I'm not going to talk about 1-2 quarter view over here. We are talking about, see, India has managed COVID well. And this management is not only limited to the health crisis. I'm talking about the fiscal crisis or humanitarian crisis. All was managed well. Because of our better fiscal management during the COVID period, is that we are not in the kind of trouble that the global, most of the developed economies are. They've overstimulated the economy and they are having inflation that they haven't seen in few generations. While we have always dealt with slightly higher inflation, and for us it is pretty much par for the course. So if you, it is reflecting in the market performance as well. For us it has been a mild correction or consolidation over the last 15-16 months. It's not been like a crash. If you talk about the crypto or the tech or the bond market worldwide, there has been a lot of wealth erosion. India has managed to retain its wealth. The moment this crisis abates, I don't know when that will happen, India should actually start growing again. A lot of the FII selling today, I believe, is a result of pain elsewhere. It is not, the financial sector in India is one of the cleanest. They are witnessing a very high growth, and that growth is only going to pick up from here. So I strongly believe from all point of view, from politics, geopolitics, the management of economy, everything, India is positioned to take off from here.
Ravi, given what's happening in the world, first US banks and now European banks, is it it's a general reminder for everyone that 2008 also started like this. What looked like a spark, we started using the word decoupling, but then we realized in the world that there is nothing called decoupling, it's a flat world. What is your understanding of the crisis in the world, and could this snowball into something very big?
No, so definitely one has to be cautious and skeptical or about what's happening in the world. Though I really believe that the risks in the world comes from unknown. And not to say that we know what is happening, but there is a playbook already available, and a decade is not too long back. You know, it's still fresh in people's mind how that crisis played out, one after the other domino falling. That was a crisis of balance sheet to a very, very large extent, and for something that was done for decades together. I mean, wrong business practices carried on for decades, and suddenly then people realized, well, over here it is still limited to some regional banks, some odd, one or so European banks, and the response time from the central bank is far, far quicker than it was during global financial crisis. So we will have new crises that will engulf us at some point of time, but at this point it is pretty clear, or I would say you can think 2 steps ahead, and even central banks can think 2 steps ahead. And you can see last weekend, SVB's depositors were
rescued,
underwritten, and this week UBS Credit Suisse deal has happened. The swiftness with which the central banks are acting tells you that they will prevent, hopefully be able to prevent a much larger global crisis this time.
So it's time to look through the crisis.
I won't say it's time to look through the crisis, but India on the other hand is still an oasis in the world. Again, I won't use the word decouple because global flows are pretty much coupled. Economies can behave slightly differently, but in the short run we are all driven by the flows, and the flows are global in nature. So as I mentioned that even though Indian banks are doing well, but that is the only place from where FIs can actually take quick liquidity out if they are facing trouble elsewhere. So that is leading to some really good opportunity getting created in the Indian financial space. So I am not worried about the crisis. It might lead to some amount of underperformance or the stock prices going further below from here. But I would say that is an opportunity for somebody who has a more than 2-3 years horizon.
Okay. The themes which were showcased at the Value Quest Inflection Day, number one was financials. That is one of your largest holdings. What gives you the confidence that financials have a long way to go? And my add-on to that question is that A, financials as a category have done well. B, they're struggling for new deposits. And C, typically if interest rate trajectory is evident, it appears that best of the NIMs are behind them. Isn't best of the banking behind us?
No, in fact, the rising interest rate is actually positive for the NIMs for the banks. It's a negative for the NBFCs. But coming back to your question about the financials being the large theme, see, if you just reverse back a little, 2017, 18, 19, that was the real tough period when we were still trying to clean up our balance sheet, where the IL&FS crisis had happened, and there was real crunch in the credit economy. people who wanted money were not getting. Today, the money is still available. Okay, it is getting a little expensive. It was probably available at 7%. Now it is available at 8.5%. I am saying liquidity is not an issue so much right now in India. The balance sheet of the banks are pretty clean. The credit growth has just come back. The confidence in the corporates to start investing for the future has begun, and it is picking up. Government is leading from the front on that front. So I don't see Indian banks underperforming at all over the next 3, 4, 5 year period. I feel, and the kind of new technology that is coming in and the way financialization is happening in India, India is going to be one of the largest themes in the world, and we don't know yet all the implications of it and how big this can become. We are underpenetrated across category. The number of bank accounts and all have just opened. The second, third order effect of this will be visible over the next half to 1 decade. So I would say absolutely stay invested in the financials for the next few years.
There were 4 companies, and I had the pleasure of even seeing their conference, at the conference, what they were showcasing about their sector and their business model. AU Financials, Praj, Wari, Datamatics, Keynes.
Data patterns.
Data patterns and Keynes. So I'm assuming that these are your portfolio companies?
Yes, they do have a presence in our portfolio, but a disclaimer over there. I mean, whatever we talk about, it will be more for illustrative purposes. We are not going to talk about the stock price or any such thing.
Yeah, but that's in public domain that they came for the conference.
Yeah, I mean, see, we essentially presented the mega trends, and the 4 mega trends are financialization, manufacturing, the consumption J curve, and energy transition. And within each of these sectors, what we did is we called the authorities on those topics over there who can enlighten us more on these topics. So the idea was more to make people see 5-10 years ahead, and these are the people, those who are riding the trends. Okay, there's a mega trend that is happening and somebody is at the forefront of it. I think they have a better vision than us in terms of what lies ahead. So that was the kind of the motive behind getting those people to talk to us.
So there was Praj and there was Wari. One is in solar, other is in ethanol machinery, biofuel. So which means that as a theme, apart from financials, you think it's going to be energy transition?
Absolutely. I think energy transition is a huge theme. See, and it is not anymore driven only by regulation. It is driven by economics. Solar today is the cheapest source of power available anywhere ever. Okay, we have not had this cheap power ever for humanity. And now the beauty of it is available most of the places in the world. It is not restricted to few geographies like it is in the case of coal or crude for that matter. So this is a democratization of energy, and it will have far-reaching geopolitical impact which we cannot imagine today. So many wars have been fought because of limited resources. And now suddenly energy is not going to be that factor. Energy is going to be available. I'm talking about 10 years, 20 years from now. So it is a huge trend that has started, and there is a global push. See, on the S curve, there is a early adoption, and it's good to have kind of a thing. But once it reaches a particular inflection point, then it becomes a mass movement. And I believe solar is way past the tipping point everywhere in the world. US has just begun because of the Inflation Reduction Act, the kind of incentives they have given to the green economy. It is going to provide further push. And solar is actually the backbone of all, because to convert any energy into clean, you need solar at the back end. Yes, solar might not be the best in terms of efficiency. For every there is only 25% retention in the overall scheme of things. But it's undeniable that the solar penetration is here to stay. The problem in India is that there are very few ways available to play this theme. And hence, whatever limited plays are available, we are trying to get them. Wari, in fact, is still an unlisted company. And so we brought companies from the listed as well as the unlisted space. Praj is on the biofuel. A lot of people consider Praj or the food versus fuel debate and it not being a very desirable thing. But as what we believe is that humanity is facing a real big crisis, and this is all hands on the deck approach. It is not about this technology is better and this is slightly worse off in the medium term. You have to deploy anything and everything that is available to ensure that the dramatic rise of the temperature in the world does not go beyond the tipping point. So we have to put everything that is available. And also it is not a one size fit all. Some country might have a huge agri waste, and that is a good thing. You know, people, you can generate energy from it. So finally it is about capturing the solar energy. The plants have been doing that since forever. We are only converting that energy back into a usable form, either it is in terms of fuel or it is in terms of electricity. So I sincerely believe that energy transition is a mega trend.
I mean, India has lack of hydrocarbon and abundant sunlight. So you will always see a business in what is available. For example, our demographics is something which is available as a proof of concept. So I think that really, you know, sets in very well. You've also had a theme specially focused on manufacturing. Now, India's manufacturing prowess is not very strong. There is an acknowledgement from last couple of years after the PLI schemes that India has arrived in terms of contributing to the manufacturing sector. But it's not easy. It's tough. What gives you the confidence that this time it's different?
So you know what, it requires many a false start for us to finally start showcasing or for the trend to pick up. So manufacturing, we have been pathetic, if I can use that word. For the last 75 years, we have not done enough to build the manufacturing capacities, and there are many things that that are lagging, whether it is skilled people, engineers being available, women's participation, R&D dollar being spent, the scale that is required, the road infra, logistics, everything has been a problem. Okay, so judiciary, if I may add, the kind of backlog that we have of the cases, the kind of implementation of the commercial contracts, and the back and forth on the taxation, there are many things that keep people off. But, and see, 2014 Make in India started, it was great on intent. But what we realize is that everything goes through a learning curve. You cannot expect it to be a hit from day one. Over a period, government realized that there are too many sectors over here. It is still a motherhood statement. The bureaucrats are not necessarily following the, towing the line. So they changed and they improvised and adapted to make the scheme more effective. They reduced the number of sectors. They incentivized and they used the carrot and stick approach. I mean, I would say Sam, Dam, Dan, Bhed, everything was used. You incentivize with taxes, you give protection with tariffs, you provide a level playing field, and you incentivize scale. PLI, I think, is a game changing.
Combination of
and in fact, they went a step ahead in terms of in defense, where they actually banned imports. So any and everything is being tried. A kitchen sink is being thrown. You are trying to get the logistics in place. We are trying to get the road network, the railway network, the airport network, everything being put in place. And we can see with our eyes, we don't need anybody's confirmation that it is improving. Are we there yet? Absolutely not. We might still take another 5 years. But the intent is very clear and the action is also there supporting it. So the confluence of all the steps that have been taken over the last 7-8 years are finally coming to fruition. And we are beginning to see some output or some results, you know, like in the case of electronics manufacturing. We have now gone from being huge importer, mobile manufacturer, we are gone from being importers to exporter. It might be a small number in terms of $1 billion export, but it's a huge thing that we are going to be exporting and not importing. And see, what happens is everybody always starts at the bottom end of the value chain. Okay, you're first going to import everything and get the assembly line in place. As we move along the curve, now again, the Foxconn is coming in with a chip plant probably, and the entire ecosystem surrounding the Apple AirPods and iPad is also coming to India. Then we will move along the chain as the component assembly, and eventually the design and the complete product is also finally built in India. I think that day will also come. Maybe it is 5-7 years away. But this is how the trends begin. And all we are saying is that we are at that inflection point, and this trend is going to last long. Manufacturing contributes like 10%, which is lower than some of the even emerging markets. So this contribution has to go higher. 25% over a 10-15 year, I would say, is a real possibility. And now we have taken some concrete steps towards achieving it.
And if the size of the economy is $5-6 trillion, 25% of that actually could be $1 trillion opportunity.
Absolutely.
So if you're looking at from your vantage point, you are clearly endorsing that the next $1 trillion theme for India could be the manufacturing sector.
And I'll add to that. This is the macro part on it being a $1 trillion opportunity. But there are very few companies of size in manufacturing. You know, you can count on fingers the number of companies that do more than 1,000 crore profit in manufacturing. So there will be many companies that will go from being a somewhere between 50 and 200 crore kind of profit company to a 2,000 crore profit company. And that is where the happy hunting ground for people like me is, that we can actually find companies that scale up in a big way. So we were talking about Wari. Wari did 70 crore profit last year, is going to do 400 crore profit this year, and they are slated to achieve 2,000 crore over the next 3-4 year period. So that will put them in an elite league of, you know, top 200 companies in India. So that is what we are looking for in our scale
companies
framework.
actually have a PAT of 2,000 crores.
Absolutely.
Just that we don't look at these numbers.
Yes.
Minus IT, consumption and banks, very few companies actually even have a record of a profit of 2,000 crores sustainable.
Yes, sustainable. Yes, that's the key word over here as well. And see, the companies evolve. It is not like they will remain a solar module manufacturer. They'll get into backward integration. They will get into adjacencies. So one-time cash flows also lead to more optionalities being opened up. They can put that money to good use to you know, build that moat around themselves, or to cross that chasm and go to the next level of growth.
Can I say, just like TMT changed the face of India in 2000, telecom, media and technology, or technology, media, telecom, whichever way we want to look at it. Then we saw the huge comeback, let's say, in the entire NBFC space. Then there was a large theme which was chemicals. Manufacturing, it'd be a large theme according to you for next couple of years. So my question is that, why did you not showcase the obvious names? Why did you showcase Keynes? We're not getting into stock specific technology, but is there a specific theme within you, like within manufacturing?
No, so we believe see, these are all chemicals is actually a part of the manufacturing theme only. However, we believe that chemicals has run its first set of course. I mean, the valuations have gone through the roof, and we wanted to showcase companies that are still at the beginning of the trend. We wanted to show how things look when the things are actually starting and how they end up being. Most of the chemical companies 7 years back, you know, they were quoting at single-digit multiple. Today, all of them are quoting at 30-40 multiple. Even commodity chemical companies are getting 15-20 multiples. So it's a trend that is well recognized. And for me, the arbitrage is to recognizing these trends way before anybody else does and betting on it and riding the trend. So that was the idea behind getting some of these unknown names to
you saved the best for the last. Wow, Momo.
No, so again, consumer, as I mentioned, the J consumption curve that we are going to witness is crazy. See, all our quick service restaurant chains in India are all MNCs. There are very few which are homegrown. The MNCs QSR chain have a big royalty to pay to their parents. These guys don't have to. And if there is an Indian entrepreneur who has cracked that, in fact, and he has a global ambition, he does not restrict his ambition to India. In fact, he wants to take the momos and Chinese, Indian Chinese to the world. So I believe there is a chance that he might do it.
What about the moat? I mean, I went to Missouri 3 months ago, and every second corner had one momo wala.
No, absolutely. But the kind of scale that he will achieve, the kind of, see, health is a conscious choice for most of the Indians now. You obviously want to eat, and I'm not suggesting for a moment that this is healthy, but it is hygienic, what I'm talking about. And people will choose the hygienic option if it is available to them. And
back with first trades, we're down 1% across the board, and you do have a little bit of volatility in the markets that breadth skewed towards the losing side, and now quoting at 16,900. No surprises given the kind of handover and what the SGX Nifty as well was indicating. Well, here are some of the big drags I just want to point out. There's RBL Bank that's down nearly 5%, M&M Finance that's under pressure. Take a look at Bank of Maharashtra that's feeling the heat. HAL, IBREL as well as Bandhan Bank and Coforge. Those are some of the stocks within the Nifty 500 that are down and out in trade. And mind you, when it comes to the individual sectors as well as metals, PSU banks and IT are the top drags, no sectors are holding out in the green. Let's hear out some top fundamental ideas then. Let's find out what Chakri Lokpriya as well as Sanjeev Bhasin are betting on.
I think I'd buy a combination of Canara Bank because it's both positional as well as a long-term. Valuations on its side. It's mid-cap, which is a large bank by in itself. I think there's a good solid 40-50% upside from current levels.
I continue to see Bosch has hit new highs. By the way, 22,000 is coming. You can add a Motherson Sumi on the OEMs. And I think Eicher, Eicher and Maruti will lead from the front. Bajaj is a very, very big outperformer along with Mahindra. But I think some of the OEMs can outperform from here.
Okay, so those were the top fundamental bets coming in from our experts. But gold and silver, they have been two particular asset classes which have been doing quite well. In fact, they have bounced back from March lows. And Bitcoin as well broke above the mark of $28,000 for the first time since June of last year. What's been aiding the rally as far as crypto and the precious metal space is concerned? Sharad is joining us with that analysis. Hi, Sharad.
Well, yes, two different asset classes, the first one being gold and silver. They are also going up because of the safe haven appeal, as well as the important thing is the store of value. Apart from this, also the regulatory interference is also coming in to actually control the banking contagion, and that has actually lifted the spirits. And do remember, an important macro event happening on March 21st is the US's Fed FOMC meeting, and that over there is expected that it will be a 25 basis point hike, and this is actually going to be a reduction in the aggression. Of course, the numbers you can see on the screen, they're up 9 to 12%, but crypto is also in the main focus. It has the Bitcoin levels have actually increased by more than $28,000, and over the last 24 hours, the global crypto market is up almost 2%. But why is crypto rallying? The main question is that, and of course, the important reason is that Fed stance in actually increasing the rates, that has actually turned a bit less aggressive going ahead. And if we see the numbers going ahead from 2022 lows itself, Bitcoin is up 79%, Ethereum has almost doubled, and for Binance also, it's almost up 80%. And over the last 7 hours as well, there has been a strong increase going ahead. Now, this rally has been actually coming in and actually because of regulatory exposure coming in from the European Parliament as well as the Swiss Bankers Association, that they have started acknowledging the digital currencies, and they are also proposing increase in deposit tokens. And recently, Fidelity also is considering enabling crypto transfer. So regulatory recognition is coming in, government approvals are coming in, and importantly, the kind of a technical up is also coming in. So that is something very important to watch out for crypto.
Okay, so a lot of factors actually aiding that momentum for crypto as well as the precious metal space. But what could aid the momentum as far as stocks are concerned and the individual chart patterns that our technical experts are spotting? Let's go across to Kunal to spot that chart buster trend.
Thank you, Anisha, for that. And today we are discussing about the charts for gold, and it's more like an update what we flagged off a few months back on gold prices, that why the gold prices are heading for a big breakout. So this is on the dollar charts for gold, and the fact that the gold price on the dollar charts is forming a classical bullish flag pattern. So as you can see that the asset class has been forming a rectangular consolidation right from 2020 highs, when gold in terms of dollar terms was almost 2,100 levels. From there on, the commodity moved into a trading zone from 2,100 as an broad resistance towards 1,600, 1,650 as a broad base for the asset class, and now it's confirmed a breakout of this major rectangular pattern. So we are likely to head into a bigger breakout for gold in terms of dollar terms, and possibly a breakout of that 2,100 mark. But the interesting bit is that the rupee charts for gold are already confirming a breakout for itself. So as you can see that the rupee charts for gold have already confirmed a breakout. We've managed to break past about the 2020 highs, which in dollar terms was almost $2,100 dollars for gold, and this was 2022 highs for gold. So we've managed to cross about those levels of 55,000. Went into a rally initially to 58,000, corrected back towards 55, and now we are almost at 59,000 levels. So which means that if the dollar prices for gold rallies further, we could be looking at gold crossing that 60,000 mark and possibly rising by another 5 to 7% at least over the very near term.
So Kunal, what's the high that you're expecting on gold? It's what, just around 60 right now, you pointed out, 70 levels?
Yeah, so I think 60,000 approximately 59,400 in rupee terms. I would expect at least another 2,500 to 3,000 points rise on the gold. Provided the dollar charts for gold also rallies up in a very significant kind of a manner.
Okay, so gold is something that is definitely glittering as far as Kunal's top pick is concerned for the chart buster. But Nooresh, what about you? Because we were speaking about how the NCLT merger is through for the HDFC twins. Is that changing your view on either of these names?
So at current levels, HDFC Bank is more like a risk reward trade. So if you look at it, the last time the stock saw a spike was at 1530. It went up to 1630 in a single day. Post that made a slow and steady recovery towards 1700. And now we are back to retesting the 1530 mark. So at these prices, it's a risk reward trade wherein you keep a stop loss at 1530. Expect a pullback all the way to 1700, and a longer term trend changes only above 1700. So a 20 pointer stop loss here for a good 100 to 150 pointer bounce is possible. So a risk reward trade on HDFC Bank with a buy at current levels.
So that's a take coming in on the heavyweight from the banking sector. But Nooresh, what about Reliance? That's been on a systemic downtrend. In fact, in the last 1 month, it's down about 10%. On a YTD basis, lost around 15%. And it's now just sub 2200 levels versus that 2800 mark, 3000 mark that we were talking about earlier. Seems very far away now.
So 2300 was acting as a base for the last 6 months. That broke off, and now the next level to watch for is 2180. That was the low in February, March of 22. If that also goes off, then we get into a much more deeper, say, drift, wherein the range shifts. So then 1850 to 2000 becomes the major support. So technically still in a downtrend, no signs of reversal as such, but the problem is the stock has this tendency to go into sideways zones for a really long period of time. So from September 20, where it topped out at 2300, the stock return is now 0. So for now, watching 2180 if it holds, but overall would only get bullish when the stock really starts reversing about 2350, 2400. So as of now, sideways to a downtrend.
Okay, so that's the take coming in on Reliance. In fact, today that stock is down 1.25%, putting pressure to the tune of around 25 to 30 points on the Nifty on the downside. While on the gaining side, it's HUL, which is actually the biggest, contributor in terms of the gaining side. And then Kotak Mahindra Bank, BPCL, etc. also form part of that list. But let's get the top recommendations going from our technical experts as well. Kunal, you go first.
The first one is Dr. Reddy, the stock providing a breakout about that 4,500 mark on spot level. So, which is to buy with 4,600 as a target, stop loss at 4,450. And second would be Kotak Bank. Apparently, this stock has been more resilient over the last 2 or 3 days, holding up 1680 levels. So, keeping 1670 as a marginal stop loss, which is to buy 1740 as a target for Kotak Bank.
Okay, so that's a take coming in from Kunal. But Nooresh, what about you? What are the stocks that you are recommending?
So first is a buy on L&T, a clear outperformer in the large cap space, a stop loss at 2150 and a target price of 2500. Second is a buy on United Spirits, which has made a double bottom reversal. Out here, the stock has been doing well over the last 3-4 sessions, even when the Nifty is not. Expecting this to continue towards 820 mark, a stop loss at 755.
All right, Rajesh Sharma joins us now, Managing Director and CEO with KPR Global Capital. Lots to discuss with him, but for a change, I'll talk about his cricket team. His team is now number 3rd. Rajesh ji, congratulations. Women IPL team is coming number 3. कब जीतेंगे इस बार?
देखिए इसीलिए सारा प्रयास है. All efforts are towards that. Let's see. It's a game. You don't know on the day of the game in the playground what happens, but yes, team is geared up, and I think all team are equally capable. So on that particular day, it matters who plays mind game better.
Fingers crossed, fingers crossed. I mean, I'm tracking the women IPL this time, and it's just so amazing to see. The impossible is looking easy now. Before I get into specifics of KPR Global, Mr. Sharma, allow me to get your sense on what is happening in the world. In your understanding, what is happening to the US and European banking system, and how different is the current crisis from 2008? Because stock markets are drawing up parallel. जो 2008 में हुआ है, will a repeat happen in 2023?
I think 2008 crisis was more of the subprime lending, where it was across majority of the banking system that lending will happen, and I think that has much wider impact. And this time, I think impact is not because of subprime mortgage. it is specific to a few banks. And I don't think that impact will be age deep and wider age it was in 2008. At the same time, it is proving that Asian banks in particular, if you talk about Indian banks, they are quite conservative, and that really have strengthened our economy that we in last many years, I can say 30, 40 years, we are not seeing that any depositor have lost money or anybody has to worry about that. So if we draw two parallel, I think we are much conservative, and that is a very, very different kind of a boost and the confidence to our economic system when we see next 5-10 years how we are going to grow. So it's quite comforting for us.
Don't see that what right now looks like a problem under control by central bank intervention could snowball. I mean, when subprime crisis started, we all thought that India is decoupled. It is the oasis. Dynamics were different. Banking sector was different. But when the financial meltdown started, it impacted us and it also hit us.
Oh yes, that way you can say when the equity flow changes, when the interest rate goes up, it affects everybody. So if you see this time also on the ground, interest rate hardening up and the risk parameters are getting tightened. So that way it is going to impact us. But if our bank continue to remain healthy, in that sense, there will be no credit freeze or difficulty in getting the credit. So that way is decoupled. But yes, interest rate will harden, equity market will have some impact. That impact will be there. So I agree with that.
Okay, let's talk about the business of KPR Global itself. And one thing that really stood out in your performance of late is how the gold business has been accelerating. In fact, you just started that business and it's already reached the AUM of around 1,000 crores. Can you talk to us about what are the targets that you've set for yourself, let's say in FY24, FY25? What kind of AUM growth that you anticipate?
So if we talk about company in general, then we will, while we have given a guidance of 20 to 27% over last two, 3 years, but I think last year we achieved about 40% growth. This year, I think we should achieve about 40 to 45% growth again. And next year, because the new product have been added and about 700 branches will be more operational, so we should again see a 50% kind of a growth. And if you talk about the gold loan AUM, while this year we might close around 1,100, but next year definitely we intend to target about 2,000 crore, and next 5 years we intend to cross about 10,000 crore book from gold loan alone.
So 10,000 crores coming in from gold segment itself over the course of next 4 to 5 years. But what about the yields and the net interest margins for the company? Because the business is quite competitive at the moment, right? And there are a lot of external factors as well which are playing out when it comes to net interest margins, etc. I understand that in the 9 months gone by on a consolidated basis, your NIM was around 8.5%, down from 9.5% that we had seen earlier. What is the sustainable level for that?
So if we talk about gold loan, takes about 12 months branches to break even, and then they start contributing. So that impact will be seen. If you've seen the last quarter, about 65 crore kind of a losses we had in the gold loan, because that is toward the investing in the branch capex, and till the branch reaches the break even, we have to keep investing. So that way there is a pressure on the NIM. But I think after 1 year, our NIM will be settled somewhere about 9.5%. And as you know, we have also infused about 14 crore rupees equity in the company by your rights issue, which is concluded last week. And I think in a couple of days, the new equity shares will get listed as well. So that will give a clear impact on the net interest margin is the growth as well.
Now, what happens to the balance sheet? The right issue is sailed through. The book value goes higher. What's next because of the right issue?
So, because the right issue, our net worth from 2,100 crore will increase to 3,500 crore. It's a significant jump. Almost 75% of current net worth has been infused by the rights issue. So, it will has the potential to get a rating upgrade. It also gives a lot of comfort to the lender that our interest costs come down, and it gives a clear pathway for us to growth. And backed of this and backed of the previous good performance, I think next 5 years we will not require any equity. So till we reach a book size of 25 to 30,000 crore rupees, we will not need any kind of equity. So this next 5 years, I think we have to just focus on improving our process, cutting our cost, improving efficiency, and growing the book. And as you know, market opportunity is quite huge.
Do you see you will be able to sustain growth as the base goes higher?
Yes, because on the back of the introduction of the new product gold loan and the new distribution. So earlier we had a branch network of 150. Now we have about 750. There's a 5-fold increment of the branches in next just 12 months. So that distribution point will be able to originate more loans. So our model has to be originate, underwrite, and collect, and we are focusing on that.
Okay, so let's look at the other aspect, which is that interest rates, when they go higher, they in a sense historically blend to a default. NPAs, at least at the retail level, they go higher. Since you are borrowing from the wholesale market, your cost of borrowing is higher, your cost of lending is also higher. When do you think the affordability factor or the risk of NPA could come? At what is that level of interest rates?
So interest rate, as you say, the kind of segment we deal with, the MSME, the informal segment, where it is not that interest rate matters to them of 1% or 0.5%. It is timely availability of money. For example, a roadside dhaba, when you require a 20 lakh rupees of loan, his business run or return on first, not return on equity. What he needs a timely money to expand his business. He wants to open one more dhaba and he needs about 20 lakh rupees of loan. These kind of customers we deal with. So we are able to pass on that interest rate to them. And if the economy is doing well and the rural economy is doing well, I don't think that 1% rate of interest make their business viable or unviable. So I see it, while it puts pressure on us because of the competition, we are not able to pass on the entire interest rate, and sometimes we have to take at least 25 to 50 basis our P&L, but it doesn't affect the asset quality. So your question is, what kind of asset quality level this business become viable? If it can continue to remain in the secured space where MSME have a NPA level below 3%, I think it is viable because every loan is recoverable. It is backed by collateral. So except fraud cases, we don't lose our capital, and we are able to recover through arbitration, SARFAESI, because there is a property to back up on.
Okay, Mr. Sharma, on that note, we'll let you go. Thank you so much for making time and speaking with ET Now today. But for the markets, there is pressure which is developing. We have the Nifty, which is below the mark of 16,900. It was taking support at that level, but that clearly has been broken. So below that mark, it's Bank Nifty, which is taking it on the chin, a 500-point gash coming in for the Nifty Bank. The advance decline ratio is looking quite poor. It's only 400 stocks advancing to almost 1,600 stocks declining on the NSE. And if you look at sectorally, all the sectors are trading with a bit of a red tinge. And it's stocks like Adani Enterprises, which are down 4.5%. Tata Motors is also seeing quite a bit of cut, 3% lower as far as that is concerned. And a lot of other names are down anywhere between 2 to 3%. We'll do one thing, we'll slip into a very short break, but don't go anywhere. We'll come back and track the markets for you.